Hello, this is Mark with Semantics Research with today's recap. So, going into today's market session, it almost felt like a summer session today with not much volume and purely one sided action. The sellers were just not there today, with early sellers being absorbed by aggressive buyers, and we slowly grinded higher all day with some profit taking towards the end. We did open very strongly on the day with internals showing and sustaining extreme prints, but we do have to consider that we have very low volume overall today. So I doubt this is very sustainable, and it's most likely another bear market rally. It appears that the market has eased its fears with FOMC yesterday, as the Fed made no recession mention, no mention of stagflation, nor 75 basis points hikes, and saying that inflation will be back under 3%. Bostic also spoke, stating that we could possibly back off and not raise rates as aggressively or even take a pause in the fall. As we do move closer to 2023, we are expected to get rate cuts. As we move closer to that, we could assume that the market may potentially turn more optimistic. Overall, quality companies had strong rallies with high risk, poor fundamental growth rallying as well. BABA, on the other hand, had better than expected numbers, which gave people hope that China's economy may not be as bad as they thought, and maybe the supply chain issues may be alleviated. Going into tomorrow's session, I expect liquidity to be very poor, as many tend to go off to vacation early into the 3-day weekend. So probably going to expect light liquidity, as most of the senior traders go to the Hamptons, with only the junior traders managing at this time. One data point to consider is that with recent reports, we are seeing consumers are spending and taking up debt to maintain lifestyle, and the pandemic actually fattened the bank accounts of many who did not get to travel or commute. So we may see GDP be okay for now, as consumer spending is still relatively strong. It seems like the market is priced so far for soft landing, as we are still trading at relatively high multiples in names like Nvidia and other quality tech names. If we were to have a recession, or if inflation remains sticky, however, then it is more likely we'll see more downside, and the low is definitely not in. It seems like the market is still concerned, however, with the VIX still remaining high, so we are not quite out of the woods yet. With the CBO releasing a testimony, they are expecting real GDP to grow at 3.1% this year, and unemployment to be at 3.8%. They stated that they expect inflation to ease and economic growth to slow, which is actually quite supportive of the Fed's case for a soft landing. So whether or not this soft landing idea will come into fruition, it's anyone's guess. No one really knows what could happen in the future, whether or not more geopolitical issues may arise, or if inflation remains sticky, or other unforeseen events. I will not be switching my bias to a bullish stance yet, as I would rather like to see the next two CPI numbers to show that inflation is truly coming under control, and the GDP numbers showing that we are still growing. Then I would be more confident in a possible recovery. If we were to show that we're not going into a recession, and then that would be one positive factor for tech. Now, if we take a look at the credit markets, it is seeming like the last 3 days are signaling that people are seeing less distress in the bond markets, and that all the negativity in the markets earlier this month was massively overblown. So going into economic numbers, real gross domestic product decreased at an annual rate of 1.5% in the first quarter of 2022, following an increase of 6.9% in the fourth quarter of 2021. The decrease was revised down 0.1 percentage points from the advanced estimate released in April. This GDP estimate released today was an advanced estimate, which stated the decrease in real GDP was estimated to be around 1.4%. The update primarily reflects downward revisions to private inventory investments and residential investments that were partially offset by an upward revision to consumer spending. Personal consumption expenditures, or PCE, non-residential fixed investment and residential fixed investments increased. And that is it for today's daily recap. I would like to thank you all for watching, and be sure to check out the links in the description for more updates on future content. Thanks.